Good morning, Chris. How you doing?
Hey, good morning, man. I'm great. How are you?
I'm good. This is Brian Jones, and I'm here with Chris Hood, professional options trader and world's most interesting man.
World
Um,
with a man with a black eye that's forming.
what
You
happened?
know, well, the oil price dropped, so it hit me in the face.
You got kneed in the face by the oil price.
I got kneed in the face. Yes, I have a magnet on my cheek. I don't know what happens, man. Every time I'm doing one guard pass, I get kneed in the head. So I've got to start wearing a helmet. I think doing jiu-jitsu with a motorbike helmet is going to be quite interesting.
That would I've yet to see anybody bowing with the helmet on or have to, like, can you go? It's like, go ahead and put your, everybody goes and sometimes they'll go put their mouthpieces in before they roll. After
Oh my God.
real, like, you go get your helmet, put it on. You're like,
I'm going to get my NFL pads. I'm going to get my helmet on. Well, you know what, considering how the world is turning, that, the government wants to protect you from everything. We might be wearing helmets just to go to the supermarket in 5 years. So
yeah, it's
let's not
padded.
joke.
Yeah, you got to be
Could
careful.
be happening, man.
You'd be hurting yourself. So, oil prices. Let's talk about this because I have a couple positions on just XOP,
Yep.
and they're not looking real great today.
Well, not today. I think it's inevitable that we would have seen some form of pullback because, oil at 130, we started to feel it here in Canada even. Oil went from, I remember about a year and a bit ago, we were paying under $1 a liter, and now we're paying close to two. So, we feel it. And when oil goes up, there's this political issue around, cost of living. Here in South Africa, they want to put rationing now on petrol, and they want to start putting price caps and stuff like that. So, it was inevitable. It had to happen at some point. Now, the way to have traded it, if you recall a couple of weeks ago, we were talking about married puts and we were talking about de-risking positions and making sure that we were standing to lose nothing should the reversal happen. So this is happening. The reversal is starting to happen. However, I'm going to open up a chart and I'm going to put on the chart of ERX because it's important to understand where all of these sit. So ERX is the double leveraged energy ETF, right? And we can see that it's still trading in a green band. The trend is not broken. So this may just be a simple pullback coming down to the 21. Now it's going to come past the 21. So we'll see it somewhere here this morning. Here is our break. If it breaks 45, 41, then we will, exercise our long put, take our position off. We don't lose anything. We're already risk-free in this position. We've been risk-free for some time. In fact, we've been risk-free from down here. So exercising the long put, we'll get back our money. We move on to the next one. Now, the issue is this. When we see trends reverse, you have to know where the money is going next. Right? This is the thing. Your money goes from one place to another. Well, where is it going? And this is the hard part, is now trying to work out where it's going. My suspicion is it's moving into healthcare, because over the last couple of days, we've seen a little bit of, net inflows into healthcare again. However, the trend in healthcare, if we go to CURE, which is the triple leverage version of healthcare, we are not green yet. We still need to get healthcare up past 119 in order for it to be, starting to go green. This is attractive. We're starting to see these squeezes starting to fire to the upside. We've got some degree of a positive trend coming, but it's not fully there. We're still red-yellow in terms of our trend. It's not 100%. So where is the money going? That's the big question. And so I think that ERX, the trend of higher prices for oil, has definitely not broken. I think that we're still here. It's going to come up. We can see these pullbacks, comes down to the 21, bounces, comes back to the 21, bounces, goes up, comes back, could bounce. We can't rule that out. So I think that there's definitely something still there. If we look at XOP, you can still see.
I'm not that worried about, I still think there's some upside.
Yeah, absolutely. I think this, we've often seen in situations where the squeeze starts to lose momentum to the downside, the refiring to the upside. So yeah, there might be a period for the next couple of weeks where we see prices start to come down, but there's a high likelihood that this is just going to bounce off the bottom and continue on its journey that way. The trend is definitely, bottom left, top right. We've got a lot of volume that's going through. I wouldn't be too concerned. I think it's frustrating for traders on a day-to-day basis. But if you turned off your computer and came back in 6 weeks, you'd probably see this on higher prices. However, we can always be wrong. So if you're doing long calls, if you're doing long shares, there's a way to insure them. All right. So make sure that if you've got a long call option with profit, just stick on a put option, just create a sort of artificial straddle. Just insure yourself to the downside. If the trend is still there in the long run, buy yourself some short-term insurance, keep yourself protected at all times. I sound like a UFC referee when I do that.
When you do a protective put like that, whether it's on like a married put with long shares or like a synthetic position, like on a long call, what duration do you look at for the put?
Technically, it depends on what I'm trying to do, right? So if I'm looking at something that's sort of a 3 to 4 month trend that's starting to form, like on higher energy prices, we know the inflation story is here to stay for a while. I will look to start it off with a 30 to 45 day put option and then do adjustments, right? So as the stock price starts to move up, let's use ERX as an example. So as ERX started to move up in price, our put option went from being under the market or under the price that we purchased. We then buy in the money, all right? We then buy slightly in the money. So we start moving our price of the stock up and we're purchasing cheaper insurance. Remember, as the price moves up, insurance becomes cheaper, put options become cheaper. So what I start doing is buying these in the money put options, slightly higher than the market price, wait for the price to match it, and then I move it up again. I'm constantly locking in the movement of price into the strike of the put option. All right, so when you do a married put, your benefit is really going to be on the strike price of the put option and the price that you've paid. So if you've adjusted it on days where prices rise, you pay less. All right, you're getting $5 of upside and you're paying $100 for it. That's the way that technically it would work. So now we get to this point. If you're going to be doing, my put option that I've got in is for July. All right, I can sit here on a negative risk basis. I can watch this fall all the way down here and I'm going to get $70 a share, whether this drops to zero, whether it doesn't matter where it goes. My put option is July 70. So I'll just exercise the July 70, lock in my profit and move away. So the married put gives you a lot of flexibility when prices become volatile. And you can see we've got a fairly wide range here. This is a 2 ATR baseline that we're using. So selecting your put option, number one, at the initial stages of your trade, when you go in, keep it short. As the trade starts to develop, push your time frames out and raise your strike prices up. And that's the easiest way to manage it. Now, the other thing you can do is once that position gets risk-free, all right, so the net cost of your stock plus the cost of your premium or the cost of the insurance added up together is less than the strike of the put. So if the combined cost of the put option and the stock is less than the strike of the put option, I'm risk-free, all right? So once I get to that risk-free state, I have two choices. I can either just leave the trade, let it carry on and make my small adjustment, or I can start adding income trades to it, all right? So the two income trades you could do, one of them is you could create a long collar by selling a short call that's out of the money, very short duration, so it expires quickly, take the income, continue to reduce the net cost of your stock. The other one that I do is I sell a put option against the long put that I've got for a second income stream. So as I've got this risk-free long shares, long put, the stock and the put option both become elements of income trades, like a covered call on the one side and a bull put spread on the other side, or bear put spread.
You're setting up a collar on it, basically, right?
Yes, but I'm going in two directions, right? So I'm selling a call option at the top and I'm selling a put option at the bottom. I know the price isn't going to drop down low and I know it's not going to go up too high, so I can get these two income streams. So that's one way that we further increase the net negative risk of that trade.
So that's like an iron condor-ish thing without the extra legs on it, I guess.
Yeah. So effectively, I would be substituting my long call on the iron condor for shares, and I'm substituting my. I wouldn't be selling the condor because my put spread would be a bear put spread, not a bull put spread.
Mm-hmm.
So it would be a slightly unique thing. But effectively, what you're doing is you're taking your two.
It's called the Chris
middle positions, which are the married put, and you're just going to create an income stream on both sides. That's all. So
it's a new strategy. You just call it the hood.
I don't know. I think someone smarter than me has probably called it, I don't know, Komodo dragon with a funny tongue or something. I don't know.
Hey, there's such thing as simultaneous discoveries, that happen all the time. So doesn't mean you can't name it. I mean, everybody.
Yeah, I'll stay out of the naming of anything. There are smarter people than me around, so I'll leave it to them to come up with something creative.
Everyone in jiu-jitsu seems to have taken moves and just renamed them for their series,
Oh yeah. No, in option trading, it's the same. I think there's 300 strategies that I've seen. I think only 8 work. That's just my experience. Only 8 work, but it's interesting because everyone that I've ever read about, followed, watched, whatever, always claims their strategy is the best. And there's no such thing as the best. What there is the only thing that works. If it works for you and your personality, then it's good. If it doesn't work for you, it's irrelevant what someone else says. I remember when I first started learning, complex strategies, I could never make them work until I realized that there were just too many legs for me to watch. So I was like, okay, well, I'm not going to do it. It's too complex for me. I'll just keep it simple. And as you go through your learning curve in options, you tend to, at the beginning stages, you gravitate towards complexity. Oh, it's got 6 legs. It must work. It must be good. It must be better. And in options, more is not better. So you got to keep things simple. So what I try and do is, trade a trend, trade the trend with as little risk as possible. Always protect your downside. And, when the trend is finished, it's finished. Don't look for reasons to stay in something that's not profitable. And you'll develop success with that. If you don't follow those simple principles, it does become a lot more complex. So, keep it simple.
So so you're saying that there's some rotation, you think, potentially into healthcare, like XLV or Cure, whatever you want to play. I was looking at some of the other, what do you think about some of the other healthcare ETFs like IHI? Do you ever trade those?
Well, the difference between them is often the composition. It's not necessarily that they're different. It's just the weightings within them are going to be different, right? So usually with the spiders, it's a little more equal weighted. You're not going to have so much concentration risk on certain individual entities within the ETF. With some of them, they're a little bit more concentrated, right? So if you're going to go the concentrated route, sometimes it's easier just to look at the constituents and then run a quick analysis of the constituents and see which one's the outperformer of the group. Because if you look at any sector, if we just pull out, let's say, XLV, for example, let's look at XLV, we'll go daily. Let me just update. Let me just log in quickly, sorry. When you start doing the analysis of the individual outperformers, sometimes the better trade is just picking the one, the stock that's actually doing better than everyone else, right? Because not everyone performs equally. So if we just pick on the sectors themselves and we click on, let's go 1 year daily, and we start looking at XLV, so healthcare. So if we were going to do a trade on healthcare, right, where would you want to be focusing? Well, there's the entire healthcare ETF. The issue is these ones that are green, right, that are already up here in this quadrant there, you don't necessarily want to be chasing trades here, all right? And we certainly don't want to be, looking at the ones in the yellow. Sorry, this thing keeps going back and forth. It's my mouse. Now, here in the red, those red guys are the weak ones. These are the ones where the money from the green is going to go to red once the rotation starts to happen. So when you start seeing the rotation starting to happen, money will flow out of the green. It will come into the red. It will push the red stocks into the blue. The blue will have also got some money and push the blues into the green. So that's the rotation. It's the sort of clockwise sort of element.
You've got a sectoral rotation, sort of a inter-sectoral rotation and an intra-sectoral rotation.
Yeah. So if we look at the equal weighted ETFs, when we start, looking at equal weighting, so we're not looking at the individual entities or individual ETFs that have got higher concentrations of certain stocks, you can still see energy equal weight outperforms everyone else. This is why we can see the trend is not necessarily broken. Sure, there's a little bit of momentum downturn, okay, and that could, lead to more movement to the downside, but it's outperforming everyone. Energy is outperforming everyone by multiple factors. So you can't just run away from there because we've had 2 bad days in a row. There is going to be an element of potentially a bounce. It's the only sector that's green here in terms of getting money, other than just the utilities. So for me, when I was looking at it this morning, I go into the normal ETF, the normal unweighted ETFs. We click on daily. And if we just look over the last couple of days, just watch very closely what's happening here with XLV. If we take the last 5 trading days, the net percentage change is very small. If we start going back a little bit, so you see how little it's changing on a day-to-day basis, 2 days, 3 days, there you can see over the last 4 days, it's positive. And so was materials, so was finance, but finance is still lagging. So finance got a lot of catching up to do. So you don't really want to be going into there just yet. XLC was up, it started to come back down a little bit, but XLC is the one I'm watching. I'm watching this one, I'm watching XLV, I'm watching XLB. I don't know where this money is going. It's not definitive for me. So look over the last 5 days. There we can see where the money is moving. There you can see 6 days, still everyone, there's energy over the last week. Energy and utilities. You see how it all, the longer you look at it, the more stronger energy starts to look. So this movement that's happening doesn't really have a lot of traction just yet. There's not much that you can go on just yet. So that's where I'm focusing now is, okay, if this energy trend is broken, and we know that ERX, if it breaks 45, it will be done. Where are we going to go? Are you going to go to cash? Maybe cash is better. If you start looking at the individual sectors themselves, let's open up the ETFs. If you just go through these, very, very simple analysis, what are we looking for? Green volatility bands. We want price above the 21. We want to be above the trend line. We want to have a squeeze. We can't go to consumer staples. Here's healthcare. Not much happening yet. We've got the crossover of the 21, but we need to be above that 132 level to get to a green volatility band. Now, could we get there? This is the daily chart. Could we get there today? Yes, we could. All right, that's a $2 move. ATR's around $2. So we could get there in 1 day. We could be up here. Then the movement could be happening. All right, I just wait for that signal to happen. I've already got one signal in. That signal we know, 53% win rate on that signal with a reasonable amplitude. So from here, yep, it's a viable entry to a degree. All right, to a degree. If you were going to do this trade and you were going to go long stock, you would have to do it as a married put, because the possibility of failing at the 21 and falling back down, very possible. We could see a continuation of this. We do have divergent high bars, 2 of them in a row, two divergent high bars. What does it mean? It means price is going to fall. Within 3 candles, we will see a lower price. So there's a candlestick sort of assessment telling us we're going to see a lower price. The price could fall back down. We could get back to the trend line. So anything above 127, we're still safe to enter a trade. If we break below 127, no, it's an out. So what we're looking for here is confirmation. We're looking for a higher high. We need to get above yesterday's high, which is 131. We may do it today. And if we see that, we could start building a position here on XLV. Similarly, we could start looking to do CURE, which is the triple leveraged XLV. Similar chart pattern, similar indicators, just higher upside, right? Utilities, similar scenario, right? You've got this trend here. You've got a moving average tool entry. You're above the trend line, above the 21, divergent high, lower price within 3 candles. We've already got that. So you see how purple bar, higher price, orange bar, lower price. Now what we're looking for is where is it going to open? So it's going to open around here. And hopefully what we do is we get above yesterday's high. If we get above yesterday's high, Squeeze looks a little done. The momentum here looks a little finished. There is no momentum, there's no squeeze. We are seeing increased volume. So this might be a possibility as well. UTSL is the triple leverage for utilities. Similar pattern, right? Similar pattern. So we've got a choice of going into healthcare and utilities. We could take our money from ERX, split it into half, put half and half. But we've got to play the right game, right? You've got to time it a little better. XME also looks positive. So money could be moving into mining, broken trend line. Here's the 21, squeeze losing momentum. We've got lots of volume. Lots of volume's has been going in here. We're going to open a little bit down at the 21. What's happened before? In a double green, we come down to the 21 and we bounce. Down to the 21, bounce. 21 holds here. We could see this bounce and move up. So this is also a possibility. Let's look at real estate. Crossing the 21, we have one signal here, which has got a very high win rate. So this could also be an opportunity. We've got a squeeze, high compression squeeze tends to fire, counter trend. Trend is currently down, so there's a likelihood this could fire to the upside. We would really need this to be above the zone of resistance and above the vol band. If it's above that vol band high, possible trade here as well. If we look at XLK, it's shocking. Look at this. Every time it's come through to the 21, it's failed. It's failed at the 21. So here, more downside probably to come. Lots of selling going on. Squeeze firing short. Don't expect this to be rising anytime soon. We may get a pop up here and then a continued down trend over the next couple of days.
That's something that could be potentially shorted at the 21.
Yeah, absolutely. These ones you can short the rip. So once this gets back up to the 21, play it back to the downside. XLC is the one that, it's so beaten down from back here where we had the exit signal back in September. Man, when this thing turns around, it's going to turn around big. So you've got to keep it on your watch list, because when this gets back above the 21 and things start to look a little green here, this could be a really nice recovery trade. Let's look at home builders. Similar scenario. Every time it hits that 21 fail, 21 fail. Let's wait for the next 21 fail. Consumer discretionary. This is the Amazon and Teslas. 21 fail, 21 fail. We'll wait for it to come again. But notice how these signals work, right? There we had a really good signal. Here was a little pop-up signal. There was a nice signal as well. Everything here works. The signals are pretty spot on at the moment. Gold miners, green, needs to be back above that trend line, possibly coming down to the 21, 35.80. It's going to be on the 21 this morning at the open. Can it hold there? We'll see. XOP, the one that you're in, double green, hitting there. It's going to break the 21, but it won't be outside of the vol band. It will just be below the 21. So the issue here is going to be, can it get back above the 21 over the next 2-3 days? But look at all these entry points. Started there, took profits. Then we had another one, plus entry. 1, 2, 3, 4, 5, 6 opportunities to enter. Really, really good trade this. If you'd gotten in back here when the vol band changed color, this vol band changing color is really accurate when it comes to choppy markets. So this was a good entry point, and you've had lots of profit opportunities along the way. Energy, same thing. December, that was the period of consolidation during this squeeze, massive squeeze that formed, conversion of the vol band, confluence of entry signals with the squeeze firing to the upside. Those are the trades that you really look for. These are the trades where once you've got this kind of alignment of signal on the oscillators and on chart, there's a big difference between how you should interpret the two. But when you've got confluence between on chart and oscillators, massive potential for a big run, which we got. And then XES, similar pattern as well. Confluence and consolidation, squeeze fires to the upside, MA tool entry, 2.1 signal entry, big move that we took from that side. So a lot of these things are just, the more experience you get reading charts and identifying those patterns, right, you'll start to see them more often. We have a couple on the watch list today. just the ones that we're looking at today, you'll see some similarities here. REGN, this is part of XLV, one of the stocks that sit in XLV. Look at that. We have a 2.1 signal, change of the volatility band from gray to green, squeeze firing long. This is the same pattern that we had. Here we had a long squeeze. Didn't you see the same thing that we had on energy 2 slides back? Same situation, change of the vol band. Now, this is an expensive stock. So to play it, you've got to be really careful because you can overprice this. Doing a married put's going to cost you 60 grand for 100 shares. So, it's a pricey stock. What you could look at here is maybe doing a call debit spread with a long put to the downside, just in case you get it wrong. You could do a straddle, a long dated straddle. You could do a calendar type straddle. So you could change your expiration dates, have a long dated call option and a shorter dated put option. And that mimics a married put to a degree. If your long call is sitting in the money. So if your long call has a delta of around 1, it's the same. You could create the same environment for a married put. So this is a setup that we see. Another one here, PST. So this is the short bonds. Okay, so shorting bonds would be a good idea because rates are rising. Here you can see a change of the volatility band. Trend has started to shift to green. Squeeze hasn't fired yet, and your trend has gone from yellow to green. So you're getting these conversions, these trend switches. Let's have a look at this one. Same thing, switch over to green, squeeze is fired to the upside. Okay, you've got volume increasing. There's another trade.
What ticker is that one?
This is AMAL. It's a smaller stock, smaller one. We've got Gladstone Corporation. This is a monthly dividend paying stock. Squeeze almost coming around the corner. And what we're looking for here is a movement above that volatility band. So once we get the close above the volatility band and perhaps a MA tool entry together with a squeeze firing to the upside, could get a trade coming in. Just be careful, dividends paid. So dividends will drop the stock a little bit. So once that comes in, then you could probably trade it from the 23rd of March. So this is on my list for later on in the month. Here's another one, shift of the volatility band above the 21, above the trend line. Lots of squeezes here. Volume breakout. You see down at the bottom there, we have that little green column at the bottom. That shows that we've had this huge volume purchase yesterday. So there may be something here, maybe something. We'll have to watch it. D-Pro, this one as well. You have a switch of the volatility band, 2.1 signal, trend starting to shift. Look at that squeeze. Squeeze is firing, counter trend. Trend was coming down. This is going up. Divergent high, low bar. Price going to rise within the next 3 to 5 bars. So this could be another trade. Look at the volume from yesterday. I bought this one yesterday. It's a company that makes drones. So it makes drones and it got a military contract. But look at the squeeze. So I bought some yesterday. Squeeze, the squeeze fired short, which is strange. It's firing short, but it's got a green momentum bar. So, if you're going to do something here, there are options available on the stock. But look at that. Here's an entry. Here's an entry, 2.1 entry. Buy small. 100 shares of this is $200. Put it in, see what happens. This could easily go back to previous highs. Previous highs are up here at 7. So that's a reasonably interesting trade to look at. So these are the ones that I'm looking at the moment. They're all sitting in that sort of, similar setup. Squeezes, change of the volatility bands, upside, things to watch. And then we've also got another watch list here where this goes to our subscribers as well, where they can go through other trades, right? They don't have to do the same ones that I've got. Here's one, shift of the volatility band, price above the 21, 2.1 signal, squeeze firing to the upside, little bit of selling volume, got to be careful there. But, here, RLI, same trade, right? You can just, we could pick anyone off this list and it will come up with a similar setup. You know, and there's also some cheap stuff, you know, penny stocks if you're interested. Yeah, you've got a 2.1 signal, hasn't got the green volatility band yet, but we've got squeezes. You see all these squeeze indications telling us prices moving to the upside. So here, you know, this is going to cost you 40 cents. Upside target's probably around 100, you know, around $1. So I don't think this is optionable though. So you'd have to buy, you know, 100 shares will cost you $40 over there. You've got a lot of trades. We're probably finding around 100 a day that come with the same type of setup. This is interesting. This was a new listing. Here you've got a divergent low bar. Okay, divergent low bar indicates higher prices within 3 candles. Bang, we've got the higher price and we're breaking to the upside of a volatility band. Look at the squeeze momentum losing downside momentum. You know, perhaps this is going to fire to the upside. It's a SPAC. I'm not very keen on these things, but you know, opportunity nonetheless. So I try and trade setups. I think that's a lot easier than trying to trade fundamentally. So that's the story for the day.
Well, it looks like there's still some opportunities left in there.
And you know what? I think the thing is, opportunities exist in volatile times. So many people are expecting opportunities to look the same as what they did back last year, where we were strongly trending up. They just look different. And if you are if your brain is only, you know, set to buy in a particular pattern or a particular way, and you're not trading, you know, for the market, you're going to run into problems. So, you know, they just look different. I mean, one of the things that we've been doing with my clients is we do this thing called a quick hits. You know, it's 5 to 6 very short duration credit spreads that are done usually on a Monday, close it by Friday. You know, very, very fast trades, but they have to be done with the tools. If you don't have the tools, you're not going to get the emails quick enough in order to get out of the trades. So, you know, we did really well last week. We're doing well this week. Those are the kinds of opportunities, you know, people who were doing 30 to 40 day put spreads last year and making money aren't going to be making that much this year using the same approach. You're going to have to shorten your time frames because increases in volatility cuts your timing. So, you know, you can't trade the same way. You've got to make those adjustments. So there are opportunities. I think you've just got to be much more selective and you've got to trade the consistency. So if you see patterns that are reforming the whole time, for me, it's always the same thing. Squeezes, changes in volatility bands, confluence of signals, high probability of winning on a trade, go small, let the trade mature. Don't put the house payment on as your first trade. That's just nuts. Small trade, one option. You know, we did a trade on Yang. I don't know if you did it, but we did this trade on Yang on this China ETF, right? So I've highlighted the days that we did the trades on. So we started our first trade on the 8th. We then did the second trade on the 9th, right? So on the 8th, we got in here. We needed some confirmations, right? This is a triple leverage inverse stock. Cannot trade it the same way as anything else. This stuff is like toxic waste. If you hold on to this stuff for too long, you can, you know, you'll end up having to sell your family into slavery kind of stuff. It's not cool. So, you know, we got in there, we did a second trade at plus 25%. We exited yesterday for 200%. We've put on a replacement trade when we did this with a portion of the profit that we got from here. We have a risk-free trade. It's now going to go up again. We're up, I think, 50 or 60% now on that risk-free leg. And again, it comes down to the same kind of setup, right? We had that entry. We had to wait. There was a divergent high. There was a divergent high. We had to wait. When you've got stocks that are inverse, triple leverage inverse, they tend to gap, right? So when stocks tend to gap, you've got to be really careful that they don't backfill. So you can't, you know, we couldn't enter here with that divergent high. There's no way I'm going to enter a trade. You know, you're going to have to, wait, let me just kill this. You're going to have to wait for confirmation. So we were waiting for confirmations. We got it there. It pulled back. It gapped up. It made profit. It's going to gap up again now to 47. I mean, China is a mess, absolute mess. I mean, you know, these stocks are just getting completely destroyed. So, you know, this might go on for a while. This might actually go on for a couple of days, and then we get up. But this position that we now have, completely risk-free. We hold no risk in it, and we've already made money. So, you know, no issues for us on that one.
Sounds good, Chris. Well, I heard the excuse me, a little bit of a cold. I heard the bell go off, so we'll let you get to your day and wish you the best of luck on getting some profits out of the market.
Awesome, man. I'll pay for some makeup to cover my black eye.
Yeah, don't let that. Take care of that.
I'll go stick some ice on it later.
Exactly.
You take it easy, man. It's good to see you, and we'll chat soon.
Yep, you too. Take care.
Cheers, buddy. Bye.